This is a market update for May 2022 and data as of May 30th, 2022. Inflation turns out to be the story for 2022. The sustained level of high inflation throughout the last 2 years points to inflation no longer being transitory. Inflation is not good for financial assets, being stocks or corporate bonds, and they do worse during the periods of high unexpected inflation. Expected inflation is fine because it's already priced into the market. It's the unexpected inflation that makes asset classes perform not well. And unexpected inflation is calculated as a difference between actual inflation and what we expect the inflation to be. The expected inflation in these calculations is represented by the net difference between the 10-year yield and the TIPS rate. And as we look at these graphs, the corporate bonds on a real and nominal basis and the equities, in this case represented by SPX, on a nominal and real basis, have performed worse during periods of high unexpected inflation, and the data has been sliced and diced based on quintiles of unexpected inflation. Small caps historically have performed better when inflation is higher than expected, and this is represented by the data. As we have looked at the small cap stocks, the return of the small cap plus the large cap stocks over the last 40 to 50 years, and we have plotted the data as we see in the graph, across different quintiles of unexpected inflation, and during periods of high unexpected inflation, small cap premium has returned, and value stocks, which is presented by the net differential between the return of low price to book stocks and high price to book stocks, are tending to do better during periods of high unexpected inflation. And last but not least, gold is the best hedge against inflation, the unexpected inflation in this case, and we can see that in the graph. Again, during the periods of high unexpected inflation, the fifth quintile of unexpected inflation, gold on a nominal and real basis have performed the best. Sustained inflation has become a risk factor in equity valuations this year, and it is magnified by leverage, long-term fixed commitments, and higher risk of a failure in 2022. Generally, companies with high stable cash flows, low debt, higher pricing power, and higher gross margins and short duration investments are the companies that have a reduced exposure to inflation risk this year. Let's look at the currencies market. Currencies, the rising yields this year have strengthened the US dollar, and as we see on a year-to-date basis, US dollar has strengthened against most of the currencies, in this case almost all of the developed market currencies and emerging market currencies, except those that are backed by commodity prices such as CAD, Brazilian real, and Mexican pesos. But surprisingly, Russian ruble has surpassed real as the best performing currency year to date this year, rising 18% against the US dollar year to date and 12% in May. And this is mainly due to Russia's capital control efforts after war started in Ukraine. They lowered the interest rates from 14% to 11%. They forced the exporters to sell foreign exchange, and they demanded natural gas to be paid in ruble, as well as the strength of the oil prices have helped them. Many traders, however, have not found this price stable and liquid, as prices of the monitors and in the physical markets are tending to be different. Indices and select exchange traded funds. As we know, capital markets have experienced a slower growth and upbeat in 2022 because of rising inflation, rising rates, Fed's hawkish policies, supply chain disruptions, geopolitical risk, volatility in the commodity markets, and overall this year, high yield, low size, and value stocks are tending to do better during the early stages of economic cycle recovery. And if you look at the indices, we can see that all of these factors, such as the rising rates of inflation and supply chain disruptions and heightened geopolitical risk, have had its impact on the equity markets, and year-to-date returns have been negative for most of the indices. And oil futures, WTI futures, and gas futures, and of course palladium, have been doing really well this year. Russia-Ukraine crisis continued to weigh on the rising inflation and tight inventories, and markets are experiencing a stagflationary environment. And among exchange-traded funds, as we see, the bargain basements of 2020 tend to do better this year, which includes oil, infrastructure exchange-traded funds, gold, merger arbitrage, and the ones that are doing worst includes Bitcoin and technology. Bitcoin tends to act like very risky equity, and the risk is magnified during high inflationary environments. Taking a long-term value perspective this year, we're going to remain focused on financial sector, oil and gas sector, COVID recovery themes, and collateralized investments that are resilient during inflationary environment. We're going to stay focused on the high-quality segments of the market. Looking at the sector performance year-to-date and on a month-over-month basis, we can see that year-to-date, it's the same theme: oil and gas, power, marine, infrastructure and asset-intensive assets, and capital-intensive sectors have been doing best. And the sectors that have not been doing really well includes computer, peripherals, electronic retail, biotechnology, healthcare, automobile manufacturers. From an IPO perspective, the transaction activity has significantly declined in 2022, and we have peaked in the highs of 2021, both on a proceed basis and on an account of a transaction basis. IPOs have declined, and this is expected as a result of the rise in interest rates, the rise in equity risk premiums, and it's becoming more expensive to raise equity in the markets, which causes the markets to slow down. From a sector perspective, financials and healthcare have been the most active sectors from an IPO standpoint. To learn more about this market update and all the details of the analysis, and to learn more about the companies associated with this analysis, hover over to our website at www.modelyzeinvestments.com and visit the Basic Modelyze tab to download these reports. Thank you.